Welcome to Wealth of Knowledge, where we dive into the wisdom of the greatest minds in finance and personal development. Today, we're exploring The Intelligent Investor by Benjamin Graham, a timeless classic that has shaped the investment strategies of some of the most successful investors in history, including Warren Buffett. This book is often hailed as the definitive guide to value investing, offering insights that are just as relevant today as they were when it was first published in 1949. The Intelligent Investor isn't just about picking stocks, it's about cultivating the right mindset to make sound financial decisions. Graham's approach emphasizes the importance of discipline, patience, and long-term thinking in investing. He teaches us how to navigate the often unpredictable stock market with wisdom and confidence, avoiding the pitfalls that trap so many investors. So, whether you're a seasoned investor looking to refine your strategy or a beginner eager to start your financial journey on the right foot, this summary will provide you with the core principles and actionable advice that make The Intelligent Investor a must-read. The concept of value investing. At the heart of The Intelligent Investor is the concept of value investing, which Benjamin Graham pioneered. Value investing is the strategy of buying securities that appear underpriced according to fundamental analysis. Graham believed that the market often misprices stocks in the short term due to investor behavior, but that these mispricings tend to correct themselves over time. The intelligent investor takes advantage of these opportunities by purchasing undervalued stocks and holding them until their true value is recognized by the market. Graham introduces us to the idea of Mr. Market, a metaphorical figure representing the stock market's irrational behavior. Mr. Market is moody. One day he's overly optimistic and offers to buy your shares at inflated prices, and the next he's pessimistic, offering you a lowball price for them. Graham's advice is simple. Don't let Mr. Market's mood swings dictate your investment decisions. Instead, focus on the intrinsic value of your investments and be prepared to act when Mr. Market offers you a bargain. This approach requires a keen understanding of a company's fundamentals, earnings, dividends, growth potential, and financial health. Graham advises investors to look for companies with strong financials and a history of consistent performance. By focusing on the long-term potential of an investment rather than short-term market fluctuations, you can build a portfolio that stands the test of time. Margin of safety, the bedrock of value investing. One of the most important concepts in The Intelligent Investor is the margin of safety. This principle is the foundation of Graham's investment philosophy and a critical tool for managing risk. The margin of safety refers to the difference between the intrinsic value of a stock and its market price. By purchasing stocks that are priced well below their intrinsic value, you create a buffer that protects you from potential losses. Graham compares investing to building a bridge. You design the bridge to support far more weight than you expect it to bear because you want to account for any unforeseen circumstances. Similarly, when you invest with a margin of safety, you're protecting yourself from unexpected market downturns or errors in your analysis. The margin of safety doesn't eliminate risk, but it does significantly reduce it. Graham emphasizes that no investment is without risk, but by demanding a margin of safety, you increase your chances of achieving satisfactory returns over the long term. This conservative approach is what separates the intelligent investor from the speculator, who often takes on excessive risk in pursuit of quick profits. Investing versus speculating, the intelligent approach. One of the key distinctions Graham makes in the book is between investing and speculating. Investing is the process of carefully analyzing and purchasing assets that offer a good return for a reasonable risk, with the goal of preserving and growing your wealth over time. Speculating, on the other hand, is akin to gambling, buying assets in the hope that their prices will rise based on market sentiment rather than intrinsic value. Graham warns against the dangers of speculation, especially for those who lack the experience and discipline to manage it. He argues that speculation can be seductive, offering the promise of quick profits, but it often leads to significant losses when the market turns against you. The intelligent investor, Graham advises, should always focus on long-term value and avoid the temptation to chase short-term gains. This doesn't mean that speculation is always bad. Graham acknowledges that it has its place, particularly for professional traders who understand the risks involved. However, he cautions that most individual investors should steer clear of speculative activities and instead concentrate on building a solid long-term investment portfolio based on thorough analysis and a margin of safety. The role of bonds in a balanced portfolio. Graham's approach to investing is not limited to stocks. He also emphasizes the importance of bonds in a balanced portfolio. Bonds, which are essentially loans made to governments or corporations in exchange for regular interest payments, are generally considered safer investments than stocks. They offer lower returns, but they also provide stability and income, especially during periods of market volatility. In The Intelligent Investor, Graham recommends that investors maintain a mix of stocks and bonds, adjusting the ratio based on their individual risk tolerance and market conditions. For most investors, he suggests keeping a 50-50 split between stocks and bonds, though this can vary depending on whether the stock market appears overvalued or undervalued. By including bonds in your portfolio, you create a buffer against the volatility of the stock market. When stocks are underperforming, bonds can provide steady income and reduce overall risk. Graham's advice is to rebalance your portfolio periodically, ensuring that your allocation between stocks and bonds remains consistent with your investment goals and risk tolerance. Common stocks and uncommon profits, selecting the right stocks. Graham's advice on stock selection is methodical and disciplined. He outlines specific criteria for identifying stocks that are likely to offer good long-term returns. One of the key metrics he uses is the price-to-earnings (PE) ratio, which compares a company's stock price to its earnings per share. A low PE ratio often indicates that a stock is undervalued, making it a potential candidate for value investing. However, Graham warns against relying solely on the PE ratio. He advocates for a more comprehensive analysis that includes evaluating the company's financial statements, management quality, competitive position, and overall industry trends. By looking at the bigger picture, you can make more informed decisions and avoid the common pitfalls that come with chasing after stocks based on a single metric. Another important concept Graham introduces is the idea of defensive and enterprising investors. Defensive investors are those who prefer a more conservative approach, focusing on blue-chip stocks with a history of stable earnings and dividends. Enterprising investors, on the other hand, are willing to take on more risk in exchange for the potential of higher returns, often by investing in smaller or less established companies. Regardless of your investment style, Graham emphasizes the importance of thorough research and disciplined decision-making. He advises against following the crowd or making emotional decisions based on market fluctuations. Instead, focus on the intrinsic value of the stocks you're buying and maintain a long-term perspective. Mr. Market Revisited: Understanding Market Fluctuations. Graham's Mr. Market metaphor is a recurring theme throughout The Intelligent Investor, and it serves as a powerful reminder of the market's unpredictability. Mr. Market is not your guide, he's your partner, offering you the opportunity to buy or sell stocks based on his often irrational moods. The key to success is not to follow Mr. Market's lead, but to take advantage of his erratic behavior. Graham stresses that the stock market is often driven by fear and greed, leading to price swings that do not necessarily reflect the underlying value of the companies being traded. As an intelligent investor, your goal is to remain calm and rational, using market fluctuations to your advantage rather than getting swept up in the emotions of the moment. This approach requires patience and discipline. Graham advises against trying to time the market or predicting short-term price movements. Instead, focus on the long-term value of your investments and be prepared to hold them through periods of market turbulence. Over time, the market tends to correct itself, and those who have the patience to stay the course are often rewarded. The Intelligent Investor's Mindset: Temperament over Technique. One of the most important lessons from The Intelligent Investor is that successful investing is more about temperament than technique. While financial knowledge and analytical skills are important, they are not enough on their own. What truly sets intelligent investors apart is their ability to manage their emotions, stick to their strategy, and remain disciplined in the face of market volatility. Graham emphasizes that the intelligent investor must cultivate a mindset of resilience and patience. This means having the courage to stick with your investments even when the market is down and the wisdom to avoid getting caught up in market euphoria when prices are rising rapidly. By maintaining a calm and rational approach, you can avoid the common pitfalls that lead to poor investment decisions. Graham also discusses the importance of self-awareness. Understanding your own risk tolerance, financial goals, and emotional triggers can help you make better investment decisions. He advises against taking on more risk than you're comfortable with, as this can lead to panic selling during market downturns. Instead, build a portfolio that aligns with your financial objectives and stick to it, regardless of short-term market movements. In conclusion, The Intelligent Investor by Benjamin Graham remains one of the most important and influential books on investing ever written. Its principles of value investing, margin of safety, and disciplined decision-making have stood the test of time and continue to guide investors around the world. Graham's emphasis on patience, long-term thinking, and emotional discipline provides a solid foundation for anyone looking to build wealth through investing. By following the advice in The Intelligent Investor, you can avoid the common mistakes that derail so many investors and increase your chances of achieving financial success. If you found this summary helpful, be sure to like this video, subscribe to Wealth of Knowledge, and hit the notification bell so you never miss an update. We'll continue to bring you in-depth summaries of the most important books in finance, personal development, and beyond. Thank you for listening, and we'll see you in the next video.